Got a few time zones here. I'll introduce myself. I think some of you guys are familiar with Kevin already, but I am our head of originations here at Easy Street. My primary focus is on the permanent debt for the DSCR, but we are very much originating kind of fix and flip, rehab, and bridge debt as well. You know, it sounds like you guys are right on the nose. We are a pure play commercial lender, business purpose lender. We do play in the residential space, right, with DSCR products, with bridge, fix and flip, ground up construction products. Really, our ideal box is something 1 to 10 units in size, and we can dive in a little more on the product level here in a few minutes. But I like to kick these off by giving everyone, call it 5 to 10 minutes from my end on the 30,000 foot conversation on who we are, where we come from, and really what our values are, and what propositions we're pushing on to our broker partners. So stop me anytime if anyone has questions, or Kevin, if you think you got any gaps to fill in, feel free to take over. But our background, there's really two ways to skin it, one of which on the DSCR and the other on the hard money, fix and flip construction side. The management teams on each respective side and the underwriting teams come from, being investors ourselves. Really, in its simplest form, we transacted about 2,600 homes, 2,600 doors for a little bit less than $1.5 billion worth of value. In Southern California. We did ultimately go up into NorCal and then out into Arizona and Nevada. For 5 years, we pushed through, scaled, and really put all those doors under our belt before we realized there's very few pure play commercial lenders in this 1 to 10 unit kind of residential space. There are a lot of players, don't get me wrong, but many of them kind of transitioned out of the conventional space and aren't looking at things as a true, more or less balance sheet commercial lender would. So, my background personally and my partner on the DSCR side's background is the small balance commercial space, as well as the CMBS world. So, we had about $2 billion to deploy ourselves on balance sheet. We got about halfway through that before we realized what an opportunity there was in the DSCR world. That was about 3 years ago. So the DSCR platform here at Easy Street, really has been a continuation of the platform that we built about 3.5 years ago. On the hard money side, Easy Street's been standing for about 8 years. We're one of the few, in fact, one of the only, to my knowledge, hard money lenders that has a north of 4.5-star Google review. We've got hundreds and hundreds of reviews. We did about $1.1 billion in volume last year. And we retain, a pretty positive outlook here in the market that we carry internally, and certainly that we've passed through to our broker partners. So we come from the investment side ourselves as equity, from the equity side as investors, and really, for a hard money loan, we got tired of taking, 14% or 13% and 3 points. There's a better way to do it. And we've carved out a handful of niches in each respective product offering to really represent that. But one of the material differences that's really allowed us to scale to the size that we are and through a pretty damn turbulent market last year is the way we're capitalized. This is the last kind of high level item I'm going to touch on before we can jump in, and I'll let Kevin give some more background on himself, and we can dive into the product level. But we're capitalized inversely to how most of the players in the space are. For sake of even numbers, most of our competitors have about $20 million worth of equity and about $80 million worth of debt facility. So they're much more levered than we are. We are the inverse. We've got 67 worth of equity and a $36 million debt line. So we are funding equity in every deal that we do. It gives us a little bit more leeway, and we can dive into really more of the nuance to it. But from the very high level, it gives us the ability to balance sheet loans as and if we need to. We're a little more flexible on the permanent debt. And for the hard money opportunities, for a rehab loan or a construction loan, We do not use appraisals, right? We have an internal valuation methodology. When we issue term sheets, they are to be perceived as gold in the market. We do not order appraisals or hybrids or BPOs. When we issue a term sheet, the terms are set, the value is already determined by underwriting. So, in 24 hours, submitting a construction loan request, you have feedback from underwriting, consummated with a term sheet saying we're good to go. So we've done enough of these flips and construction projects ourselves as the investor to be comfortable enough to not require an appraisal. It's much more conversational. So, the way that we're capitalized has allowed us to push the boundaries on a few pieces of the product that really began as niches and ultimately have become our bread and butter, right? No appraisal on the hard money. Things like short-term rentals or mixed-use opportunities, right, for the DSCR. Carries a few more characteristics of a true balance sheet lender, but we are offering, DSCR loans on a short-term rental or a DSCR loan on a mixed-use opportunity. So, the way that we're capitalized and our background on the investor side as investors has allowed us to be a little bit more flexible in some ways, and a whole hell of a lot more flexible in others. So, that's kind of the context on how we got here, the way that our shop is built. And ultimately, like I said, we did $1.1 billion last year. Our target is $1.5 billion here this year. So we are still planning to scale. We are striking on that trajectory here through Q1. We've all seen a lot of players kind of enter and exit the space, especially last year, but we continue to grab market share. We continue to establish new and very strong relationships with our broker partners, and happy to dive in on exactly what it is that we offer the wholesale channel. But I think I'll pause there for a second and give Kevin a second to give some background on himself before we jump into the product level here. I think you guys might be muted over there.
Sorry, Colin, what was that?
Oh, I didn't know if you guys were muted over there. I was going to give Kevin a sec to jump in on his background, but yeah.
We were a little muted.
Sorry, we had
all good.
So Kevin is here. Now we're not muted. Go ahead, Kevin.
He's gonna go. Good morning, iCore team. How are you guys today? Hope you're all having a great day. Thank you for the opportunity for Colin and I to present our offerings to you guys. Just want to give a little background on myself, and I've been in this industry since around 99 when the 125 seconds were prominent and exiting the market. I'm primarily a residential wholesale executive, and for over a decade I was a regional manager for commercial lending space. Mostly the wholesale space. I have done some retail in the past. I function much better in the wholesale space. I like helping you guys help your clients. And that's really my background. Colin and I have known each other for quite some time. Reached out to Colin and wanted to join this venture with Colin and Easy Street Capital to grow and bring a lot more awareness to what we have to offer the market.
Very cool. Well, look, Kevin, I think it makes sense. Let's jump in. I'll share my screen here to walk through, and just to the iCore team, I'm going to roll through a handful of our kind of marketing material, pieces of collateral for you. I've got these all in a zip folder for you, so happy to send these out to you after the call, so you guys have access to them digitally. Very happy to have you guys distribute them yourselves. We also have put your branding on a handful of items like our term sheets and applications, et cetera. But I will go ahead and do that here now. I think it, and let me know if you guys can see this. Are you seeing the screen here?
Yes, we can see it.
Okay, very cool. I think it makes sense to start with how we differentiate the wholesale from the retail platform. as well as how we differentiate our registered signature brokers versus just the standard wholesale channel. So, this piece of material really, it does a very concise job of showing you what the differentiators are. But at its core, we are offering rate locks, reduced pricing, improvements on pricing,
Outlet covers.
and full white label on applications, term sheets, et cetera, which we've already developed for you guys with your branding and your logos. We charge no fees. We are a no fee lender. So at closing, there are no processing fees, no doc prep fees, no underwriting fees. The way that we process these loans is by collecting at true and actual cost for those pass-through expenses. So, you may be used to something like a $12.95 doc prep fee with another lender. We do not charge those. We will charge the borrower only for the true cost to draw those loan docs. So if loan documents cost $400, they're paying $400. They're not paying an arbitrary fee around that. This is uncapped compensation and YSP. And obviously there's lifetime borrower protection, right? So I believe you guys are already registered. So this is moot to discuss really the standard wholesale channel, but some of the differentiators there, if you're competing, or rather you will not be competing with us on the retail channel. And this is primarily for DSCR, right? You don't need a rate lock on hard money because we're closing those in about 5 days. And we'll get to the hard money here in a second. But if you're worried about, a platform with an existing retail channel, that's a very real concern, depending on the platform, right? It is not here. We are wholesale people, as Kevin said. I come from the wholesale space my entire career here in the mortgage industry. So I'm a very firm believer this is how you build and scale production. On the retail side, we do not offer rate locks. We have approximately 37.5 basis points higher interest rates for a retail transaction. We do not offer any white labeling, obviously, and we do charge fees on the retail channel. So, for the DSCR side, I think it always makes sense to start here. These take a little longer to process, right? These are about 30 days to closing, compared to our hard money, which is more like a week, 5 days start to finish. So this signature broker program, we really just developed to get real legitimate shops onboarded with us, as any lender does, and to offer some differentiators. So, as we move on through these items, if anyone has any questions or there's something not inherently clear in the material, just stop me and let me know. But we're going to dive into the product level we'll start with DSCR and we'll close out with the hard money, the fix and flip, right? So on the DSCR, those cookie cutter kind of standard long-term rental opportunities, those are ones that we're going to treat as really any other DSCR lender would, right? 80% loan to value on a maximum. We're looking for the 1.0 DSCR, but we can offer no ratios, right? Less than 1. I really want to focus on, there's so many DSCR players out there. I want to focus on our differentiators and our niches, right? So, one of the largest, if not the largest differentiator for us is the short-term rental space. So we are lending on STRs with projected short-term rental revenue. So I think there's a few players right now that are doing this. We've been doing it this way, underwriting short-term rentals with what's called AirDNA. If you're not familiar, it's a website that you type an address into and it pulls rent comparables from Airbnb and from Vrbo to give you really a significantly higher rent estimate than a standard market rent schedule, right? So we're actually qualifying and closing loans with that. We've been doing that for almost 2.5 years now. So there have been 2 or 3 players that have entered this space with an AirDNA qualification, but none of them have been doing it as long as we have. We've underwritten to the same guides for 2.5 years. We've had one single credit policy revision in the last 48 months, right? So, there's minor tweaks here or there as it relates to seasoning, et cetera. In terms of rent qualification, this is really where we shine. When you look at these short-term rental opportunities, here's a few tombstones here. We're looking at, Fort Washington, Maryland. This is a rural market, right? This is where a market rent schedule and an appraisal is very rarely going to cash flow a $1.3 million loan, right? It's few and far between that you get a long-term rent schedule that covers. This is one that we qualify, right? We pull AirDNA and we use the Airbnb-based rent schedule from that. And there's a lot of these examples like that, right? Victor, Idaho, again, somewhat of a rural market. This one is actually in a planned unit development, but it's tough to cash flow these on a market rent schedule. This is where the short-term rental product really comes into play. There's really no material difference between this and a standard DSCR loan outside of how we qualify those rents. Before we move on from this product, do you guys see a lot of demand for short-term rentals? Is this something that's picked up for you in the last year or two? We seem to have felt much higher demand for this product in the last probably 12 months. But is that something that you guys run into with the iCore book of business?
Any yellows out there that might be bumping into this? Dominic, Oscar?
Not so much short-term rentals, but definitely more on DSCR products for sure.
Yeah, so this is a DSCR product, right? So this is the non-QM, no tax return. Really, it's the use of the asset that's differentiating it, right? So those STRs, anytime you see them, a little tricky to qualify. We don't have an issue there, and this is really one of our strengths. Another part of the DSCR offering that we've really gotten a lot of traction with is the short seasoning for investors coming out of rehab, right? I've got a few bullets here, and Kevin, I think you've identified a few others that, to be honest with you, I thought were pretty standard in the guide set that I think you felt carried a lot more value. But for a cash out refi, let's say you have an investor buying an asset for 300, putting 100 into it, and it appraises for 6, right? And they want to pull their cash out 90 days into it. We can do that off of the appraised value, right? We need 3 months seasoning for a cash out refinance. That'll get you to 70% loan to value. And as soon as you cross the 6-month mark, we're up to 75 on that. So, short seasoning on a cash out refi is a big part of the business we get. We do have an in-house hard money team. Is really one of the large drivers there, is taking out, paying off some of our hard money clients as they come out of their rehab. So, kind of pairing that, and Kevin, if you have, any other pieces of the guides that you think really stand out, I think another one is that we don't do rent verification. So, if you're looking to close a DSCR loan, and let's say your investor, they take their rent payments in cash, we don't have an issue with that. We're not going to ask to see those receipts. We're just going to ask for a copy of the lease, right? So we do win business there as well. That's, again, kind of the general theme here is that we're trying to do, and everyone says this, but we're trying to use, logic and reason to do common sense lending here, right? Our guides are very intuitive, and we're a little more conversational, where if there's a good narrative for an exception on something like seasoning, that's something that we'll look at, right? Those are exceptions that we do fund. So just generally on the DSCR side, we're a little more flexible than the next guy. So seasoning is a big part of it. Short-term rentals are a big part of it. Another piece of this is that we are still going very strong with our portfolio financing on the DSCR. So, we've had a lot of competitors drop out of that space as of late. We are still offering portfolio financing with no tax returns, no rent verification, true DSCR loan with a PITI underwrite, up to 20 units in one portfolio, right? So, right now we're looking at 180 units out in Wilmington, North Carolina. That's an opportunity that it looks like we're winning here, because our competition is I believe they're 25 basis points lower than us in interest rate, but it's a full doc product, right? So they're looking at tax returns, rent verification, et cetera. Global income. We're not going to dig under the hood. we are still doing this asset-based lending, right? To tie out the DSCR product offering, we do go to 10 units with a DSCR underwrite. So again, the expense load there is we're cash flowing. We're looking for that 1.0 or the 1.15 for a multifamily for a 5 to 10 DSCR. We're only considering tax and insurance in our expense load. So we're not underwriting repairs and maintenance. We're not underwriting utilities or property management fee or vacancy, right? So on that small multifam, 5 to 10 unit multifam, where we're writing 30-year products with a very lenient set of expenses, so we're qualifying much more, right? And our seasoning requirements go hand in hand with that, right? On a rate and term refinance, we don't have any seasoning requirement. We can close those rate and terms the day after they close their purchase. For a cash out refi, right? That's 3 to 6 month mark. That extrapolates out to that 5 to 10 unit product. So we have seen a lot of business there, particularly in the more urban MSAs. We see a lot of it out in Cali. I assume that's where the bulk of y'all's business is, although I do know that you're nationwide. That 5 to 10 unit product is very strong. And what complements that is 2 to 8 unit mixed use. The same components to that stand. It is a DSCR loan, it's a DSCR underwrite, but we can do those 2 to 8 unit mixed use deals as well. So if you've got a nail salon or a restaurant on the first floor and a couple apartments up top, right? Those are deals that banks don't really love. They're a little tricky to place. No one really knows, is it commercial, is it resi? Those are opportunities that we place as well, right? So that's really, I think that covers our bases on the DSCR. Kevin, do you think there's anything notable that we haven't covered on the DSCR?
Yeah, I'll just add a little color to that. Colin did a fantastic job on that. That was very thorough. But I would like to bring up, our gift funds. A lot of people sometimes are looking for gift funds and they get limited and the clients don't quite have the gift funds they need. We're very flexible and we're not gonna not look at a deal because they don't quite have 10% of their own funds to bring in. So that's another thing that I'd like on to.
Yeah. And that's, so it's a good point. For gifted funds, all we ask for is a gift letter. There's no sourcing and seasoning on those deposits. In fact, I closed a deal on Friday last week where it was an 80 LTV loan, and all 20% of the down payment was gifted funds. Now, our sponsor did have adequate reserves in their name, but the down payment was gifted, right? So those are items that we're a little bit looser on as well.
And I'd also like, Colin, if you'd like to we also we like midterm rentals as well. And that's become, I think, a great opportunity for realtors and investors alike, especially with the market and the rates kind of climbing the way they did last year. I think that's a great opportunity where investors are still finding value for their return and the opportunity for that asset to still pay their debt. And I think,
Colin, that's it. I mean, that's a big opportunity as well. And really, as and if y'all run into opportunities that are not long-term rentals, but are standard, kind of 1 to 4 unit resi or 1 to 10 unit resi assets, those are tricky to place. We will look at any opportunity there, whether it's short-term rental, midterm rental, or long-term rental. Those are very big parts of what we do. So we actually, I'm in San Diego here right at the end of the month at the midterm rental conference. We're up at the OCN conference here in a little more than a month, beginning of May as well. But this midterm rental summit, we're the keynote sponsor there, and we have many referral partnerships for those midterm rentals. So there's a lot of demand for that right now, and really there was during COVID as well. The travel nurses that needed 30 to 90 day leases but didn't want to commit to a full year, right? That midterm rental space has really come into full force, and we are on the front edge of financing those opportunities. That and the Airbnbs, we do very well in. Those are a strong part of our offering. I mean, to be honest with you, anytime we see an Airbnb or a midterm rental opportunity, we start smiling year to year. We're one of, if not the only lender that can qualify every one of those opportunities to some capacity. We have a lot of ways to qualify the STRs, whether it is the market rent schedule, whether it is AirDNA, or it's a trailing revenue statement, or it's a short-term rental based rent analysis from the appraiser, right? There's really 4 or 5 ways to qualify rent there, and we are comfortable with all of those. So, what we offer in that space is really certainty of execution. There's a lot of lenders that allow for short-term rentals, but they will require that they cash flow on that 1007, right, on the market rent schedule. We don't have that requirement, right? So we really offer optionality and certainty in closing those opportunities. And I think we can move on to our hard money product. I want to make sure we have time enough for that. We have a very interesting fix and flip product. And keep in mind, I do need to update this. I'll call attention to it now so we don't get any crazy concern there. We are not a 2 to 3 point lender on every deal. I'll drill into this in 1 second, but on the fix and flip side, we do not use appraisals. So our value here, our value prop is if you have a client that can't wait 30 to 40 days on a contract to get to closing, it's a great use case for us. Just a quick kind of walkthrough on terms. Anything 100K to 2 million, we're going to look at without batting an eye. We will go north of 2 million, but we're going to take a closer look at those deals. We're probably going to ask for a little additional due diligence up front, right, about sponsor experience, et cetera. Rates are down to 8.9 for the very qualified sponsor that has 4 or more projects done in the last 2 years, up to 10.9, which is the standard interest rate for either a first timer or someone that has 1 project's worth of experience, right? That 10.9. These are interest only loans. There is obviously no prepay on these. The term is anywhere from 6 to 12 months, and we can go up to 18 months if desired. We're just going to need to understand why, right? If it's a construction opportunity, that generally makes more sense, right? For a 12 to 18 month term. Loan to cost. Right now, our maximum is 90 for an Uber qualified sponsor. So again, we'll go to 90 on cost for an investor that has 4 or more projects completed in the last 2 years. If they don't fit that bucket, we will be 85% on cost, right? Loan to value, this is our loan to the after repaired value. We want to stay within 70% of loan to ARV. And we are closing these deals in as fast as 48 hours. We do not use appraisals. So, the way that I like to communicate this to our broker partners is it's really no sweat off anyone's back to work through our application. It is an online app. It takes 5 minutes or less. If you have an opportunity, we get feedback from underwriting within 24 hours. We get a term sheet. Kevin, I'll break after this for a second to let you, I'd like you to talk through that last hard money deal that we just closed. I think that's a great example. If we get a submission to underwriting, we have feedback within 24 hours. If it's submitted in the morning, we generally have it same day. If we get a term sheet there, we are ready to close that loan. No appraisal, no BPO, no hybrid desktop valuation. As soon as we have title, insurance, the borrower's financials, and the entity documents, that's it, right? Now we'll also need a scope of work, right? Obviously, if they're doing rehab on the project, but very, very straightforward process for the hard money, and we're closing these deals super quick. So, we see a lot of one of two things. One is if your clients, these borrowers are working with a wholesaler and they get a contract flipped over to them, and they only have 2 weeks on that contract, we're a great option here, right? We're closing very, very fast. You need to close in that 2-week period. Or let's say you're in progress with another lender and they're taking a little too long, or the appraisal gets delayed and your contract close date is coming up. we can turn these deals, if you have a full file, we can fund these loans start to finish from submitting the application to wiring money in 48 hours, right? So those are great use cases for us. Now, Kevin, I think you had a great example of a first-time client to Easy Street with a first-time borrower getting a hard money loan done here. I believe it was Friday of last week, or maybe it funded on Monday. But I'm pretty sure we saw that deal Wednesday of last week, and we funded it 72 hours later. Can you want to talk about that one really quickly, just what that process looked like?
Yes. Sure, Colin, thank you. Yes, we had a great example of that is we had a listing agent come at me that had a client that was nearing the end of his contract, and they had placed it with another lender. And I think where the challenge came was that everything went smoothly until they did the appraisal, and the appraisal was fine, but the lender just didn't, I guess it wasn't agreeable to the appraiser's valuation conclusion. So the lender wound up turning down the loan at the 11th hour, and he reached out to me. We were able to make sense of the opportunity. He was quick on his toes, reshifted the opportunity our way. We had it into underwriting on I think Thursday evening, about 5:30. Friday morning, I had underwriting conclusion. They were very interested in the opportunity and saw the value there. And later that afternoon, he issued a term sheet. And as Colin stated, those are gold. That's pretty much a closing document. Get us these document items that we need to close, and this is a done deal. I think within 3 days we had docs in escrow and closed and recorded the next day and saved the guy's deal. And he's very grateful for the opportunity, and not only would he have lost his listing, his client would have lost that business opportunity as well. So
they earned his money, right? They had money hard on that deal as well. Their EMV had gone hard.
Yeah. I think was it 25 grand of earnest money deposit and escrow.
Yeah.
You'd have lost that, and the upside of his $300,000 in equity that when he completes this project and turns to sell, he would have lost that as well. So it was a great opportunity to show and build trust with him as for what we can do.
So, kind of boiling that down, there's a full package with another lender that was kind of flailing about and ultimately declined the opportunity because they didn't agree with the borrower's valuation, right? The deal came over to our side, and our underwriting team felt the borrower was correct. The value was about right? So we didn't even look at the appraisal that was done. We applied our own valuation methodology, and it's much more conversational with our clients about help us. At the end of the day, you are our broker partners and your clients, you understand your market better than we will, right? That's where your experience and your client's experience lies. If you have comps to support evaluation, we are all ears, right? So in this case, we threw that appraisal out and we used the borrower's valuation because we got comfortable with it, right? There's comps to support that valuation. So in 72 hours, they went from having no option to having a closed loan with docs at title, right? Really, really great example of how our fix and flip opportunities work. And that process is the same for our build loans. This is our, we've coined it. Yep. Can you hear me?
Just real quick. Yes, this is Kevin. Hey, I think somebody has a question before we move further past.
Yeah.
I think it was having to do, I'm not sure who's asking, but.
So it's Dominic.
Oh, Dominic.
Oh, I can see it. Okay. I think I've got it up here on the screen. So if we have someone buying from family, are gifts of equity allowed on the bridge loan? So we do not allow gifts of equity. We do allow gift funds, right? So houses worth 400, 550 ARV. So that said, if they're simply getting a discount on the purchase price here, what we're going to look at is in this case, we're going to look at their effective purchase price, but we would fund 100% of their rehab, right? So we would lend them 85% of this 200, and we could lend them up to 100% of their rehab. As long as this 550 ARV makes sense, then that's a deal that we would look at, right? So we're not going to lever up off this 400 for the purchase price, but we will do 200 and then 100% of the rehab there. So I would assume if it's worth 400 and the ARV is 550, they're probably putting, I don't know, 50 grand into the house, right? Worth of rehab. We would be funding that. And can you elaborate on the draws, inspection needed, minimum draw amount, and what is the fee for each draw? Yep. So we keep our draws department in-house. This is another piece of our hard money offering that really people have clamored to. Draws is the department is in-house. Actually, I'm looking out of my office window and their team is sitting right out on the floor. Our servicing team is also in-house. So anytime one of your clients has a question about their ACH info, they need to submit a draw. They're requesting a payoff. They need an extension. We are one call away. We do not outsource these departments. They are all in-house. The team is here in Austin. And I didn't say this earlier, but it's worth mentioning now. Our headquarters is Austin, Texas. We do have an office in Irvine. We have another office in Philadelphia. So we do have coverage nationwide. We've got an underwriting team in Florida, and we also have an underwriting team in Dallas. Right. So we do have coverage in really the major markets and regions that we plan. That said, for a draw, we do not need a formal inspection. No, all we need is evidence the work was completed. So what we recommend to our clients is there's many ways to do it, but they can either take a video of the home showing they've done the work, or they can use an app. I forget the name off the top of my head, but it's a free app that you can download, and it has a checklist. So it's essentially our draw requirement checklist built into the app, and they can go in and upload photos to verify this work was done. There is no minimum draw amount, and the fee for each draw is $400. I'm sorry, it's $450. Very cool. I will, and that is the same here for the fix and flip versus the ground up construction. Everything is in-house. And arguably, draws are much more important for a ground up construction loan. And what comes with that is I'm positive if y'all have brokered loans to other fix and flip lenders or construction lenders, I'm positive you've gotten calls from your clients saying, I need a draw, right? I'm having issues getting this draw done. If it's at the end of the month, a draw will take us 3 to 4 days, right? We have a lot of requests right at the end of the month, extensions, payoffs, maturities, et cetera. If the draw requests come in anytime other than the last week of the month, we're turning those in generally 24 to 72 hours, right? Depending on bandwidth. So our draws go out pretty damn quick. We have a team of 5 that sit here all day, every day, doing nothing but fielding draw requests, right? Now we've got a lot of loans on the balance sheet, but they are moving about 100 draw requests a day, which is awesome. It's really huge bandwidth. So on the build loans here, these are admittedly a little trickier to get done right now, right? So let's walk through the terms and I'll drill into why, but loan to cost, we are at 85% max. That is for very experienced investors that have done this before. If they only have 1 or 2 projects under their belts, we're very likely going to be at 80% on cost, right? This is for experienced investors up to 85. Loan to ARV, 65. Again, we are in the business of funding good deals with margin on them. We want our investors to be profitable. If the deal is not profitable for the borrower, for the investor, we're not going to finance it, right? We're in the business of making money, good loans. So, again, on a ground up construction deal, those margins are generally larger, right? Otherwise, it's not worth the time and effort and money, right? To go and do that deal. The terms here start at 9 months. They do go up to 12. And again, if you need a 15 or an 18-month term for your client, help us understand why. Everything we do is a little more conversational, right? If you think the value is 550, send me some comps. Help me understand that. If you need a 15-month term, just tell me why. Okay. Hey, I've done a project in this market before. I know my contractor, and I know that if I order windows tomorrow, they won't be here for 11 months, right? There's supply chain issues. Fantastic. Here's a 15-month term, or here's an 18-month term. We have no issues doing that. We just want to understand why. Again, loan sizes, anything in this range, we're not really going to bat an eye at. We will go larger. Anything larger than 2 million, we're going to take a closer look at, right? The interest rate, we do start at 11.9, but we will come down from there, right? If we have an investor that maybe they've done 4 builds in the last 2 or 3 years, we can come down to 10.9 out the gate. And if there's a lot of competition on the deal, we really, really need to stretch, but it's a great opportunity and it's a very qualified sponsor. We can get down to 9.9 here, right? Now that's pretty tricky to do. We want to see that the borrower has a lot of experience, maybe 4+ projects in the last 2 years, but those are terms that we write. The points here, again, I'll dive into the points here now. We need at minimum, and full transparency, this is one of the larger hurdles for our broker partners. But let's kind of chat it through. Our floor points that we collect is 1.5, right? That is the bottom dollar for us in terms of fees. Now, the reason we do that, and admittedly, there's a lot of players that will do 1 point. I think there's a small handful that will do maybe 75 bips. Our value, it comes in a few different ways, and we need to collect points for that in exchange, right? We're closing in 48 to 72 hours. We are not using appraisals. And when you get a term sheet, you have 100% certainty that we're executing on that deal, right? So, I like to think of this, differently as it relates to fees. If you're talking about a $300,000 loan and there's an appraisal involved with another lender, let's say they're quoting you 1 point on their origination fee. Well, if they're billing the borrower for an appraisal, that's $500 to $700, depending on the market. Effectively, their true cost of fees is more like 1.3 or 1.35%, right? We could do that deal at 1.5, right? And then the delta in true fees to the borrower is much smaller than it really seems. So I did want to make a point that, we don't require 3 on a build loan. We do need 1.5 on both a fix and flip or a build loan. And really, that's just a function of how we operate with the rest of our process and terms, right? And I think I saw a question here. What history does a builder need to have in order to qualify for the lending program? So for a build loan, we require that the borrowers right now, to get a ground up construction loan, we require that the borrower has experience with a ground up construction opportunity before, right? So if they've done a construction op sometime in the last 36 months, that's a borrower that we have an appetite for. Now, if they've done a construction opportunity older than 3 years ago, that is a loan worth submitting. We do make those exceptions. We just will look a little closer what that experience looked like. So in terms of documentation, what we're going to look for is verifying that they purchased an asset and looking at the HUD from the sale of that asset, right? Pretty straightforward. And that's my 30,000 foot on this. Kevin, he closed a fix and flip pretty recently. I know we've looked at a few construction loans. I'm obviously you're submitting and closing, a few more loans than I am here today. I'm a little bit more above this. I've got a rock solid understanding of the product, but anything in between here you think I might have missed? Anything, to put some examples to that stands out to you?
Absolutely. One thing I wanted to share was the underwriting and the processing team with these private offerings. They are geared to close quickly, and I've never seen an internal machine move the way they do. I was always in a response mode to them, and I was very fortunate to have a client that had his wherewithal and the understanding of what we needed and how we needed to proceed, and his speed on accomplishing and meeting those goals really made the difference. So one thing I would like to say is they're pretty serious about, once they make that offer, as Colin said, that is a golden ticket, and it's as quick as we can move, and I can assist you to get them what they need to close. But they're on that turn schedule to get that done and your client financed immediately. And helping you get on to your next project.
Yeah, we are very much in the business of closing loans. It's funny that you have to say that, but it feels like there's a lot of lenders that are not in that business. We like good deals. We like good sponsors. If you bring us a good deal or a good sponsor, we will bend over backwards to make it happen. But to Kevin's point, if we put terms out the door, we get a signed term sheet. We're not a big fan of sitting around waiting, right? We like to move. We like to move fast. We like to honor our commitment to our clients that our closing time is as fast as 48 hours, right? Just an internal benchmark that we set is if we have a signed term sheet for more than 5 business days and the loan is not yet closed, we do an audit on the file to understand and just to make sure there's nothing on our end holding us up. And we make a call to those partners to say, hey guys, we've got a file ready on our end. All we need is a copy of the insurance policy. If you don't have one quite yet, here's a referral for an in-house insurance provider, right? Now you don't have to use them. It's not a requirement, but if this is what's holding us up from closing, we're going to provide some solutions, some optionality to get us through to closing, right?
And I'd also like to add on just the communication from our own platform and our own operations. They're very, they communicate very easy. They're always, everybody, even calling here is accessible. Anybody's accessible. We're all here to get these loans closed, to bring value to you and your clients, and to get it done quickly. So whatever it takes for us to do that, we stand up for that. Would also like to let you guys know that we do have you guys. We are offering you a signature position within our company to the effect of white labeling products for your offerings to your clients. Colin, I don't know if you have those able to kind of give them an idea of what.
Yeah, sure thing. And while I'm in here, I'll show you
get back with you on that, Oscar, real quick.
Yeah.
Oscar has a question on if we do.
What's the cost for an extension in the event 12 months have lapsed? The cost for an extension is 1 point. 1 point on the outstanding loan balance, 1%.
So if we have any possibility of that project might supersede that time frame, then we need to provide something up front to already come forward with an extended period past that 12 months.
Correct. Yeah, correct. So if there's an understanding up front, hey, this is going to take longer than 12 months, simply let us know. Let's talk through it so we can start with a longer initial term, right? So we can avoid having to pass through an extension fee. And again, all things within reason. If there's a great narrative to support that, we are all ears. But if a borrower says, hey, I need 15 months to do 50 grand worth of rehab, our answer is probably going to be no, right? A $50,000 rehab project, that should be done in about 90 days, right? So that's one that we probably would cap at 9 months, right? This is, what Kevin was talking about. We have branded our application, our credit authorization, and our term sheet with I-Corps information. So you guys are already onboarded as signature brokers. You are already up with our white label product. Our application is very straightforward. It's a little more robust than a standard DSCR app. This app will cover, and this is the DSCR application for hard money. It is an online app. Kevin can send you guys the link. It is very, very, very quick. It takes about 5 minutes. It's super straightforward. But our DSCR app is really intended to capture everything. And this is for multiple sponsors. It's really only 4 pages long, right? If you have 4 sponsors, you can add them all on. The DSCR app is very all-inclusive, so to speak. All the info on here is essentially what we need to close a loan. Processing and underwriting is just a function of proving that up, right? But you guys are all onboarded as signature brokers with your branded collateral here today. I'll show you the term sheet here as well. This is what a copy of the formal term sheet is going to look like. Again, pretty straightforward, captures everything, estimates on monthlies, etc.
And down at the bottom, we will have Christopher's blessing for these loans.
Yes, yeah. Well, that is, I think we've got about 5 or 6 minutes here. I didn't want to drone on for too long. If anyone has any questions, we've got some time. Otherwise, I very much appreciate the opportunity to allow us to come on and share our products with you.
Anybody have any questions?
They always do that. If
Sorry,
anybody have
not
any
me.
questions, you guys can unmute. Who was that? You guys can ask away.
Yeah, I have a question. So Kevin, in the event, like let's say for instance, if one of our transactions doesn't fit per se you guys' guidelines, do you guys have other sources that are, I don't know, I don't want to say more aggressive, but where it fits their particular guidelines?
You mean like another lender?
Yeah. Are you guys able to like broker it out or is this pretty much book stops with you guys?
We're a one-stop shop. We manage everything. And if there's if there's something that just doesn't meet our platform, I do know a lot of other people in the industry and different facets of their offerings, and I'd be happy to make an introduction to help you guys close a loan.
Yeah, I mean, Kevin, we both come from, you've spent time in the true resi space, the commercial space, small and mid balance. I come from the small balance to CMBS world. If you guys have a deal that we do not have an appetite for whatever reason, we've got a pretty wide net. If there's a referral that we can put you in touch with to get those deals done, at the end of the day, we're in the business of providing you guys as much value as we can. And if it's something we can't fund, we will very much tap the Rolodex to see if we've got resources for you, for sure.
That's awesome. Yeah, because we don't play too much in the space, so I'm sure you guys have relationships and other partners.
Yeah.
That perhaps you guys have known in the past. Appreciate
Absolutely. Yeah. And Dominic, you asked, you got a builder who wants to build in a new state, but has experience in other states. Yes. Yeah. We'll look at that. We will do so, we'll look a little more closely than if they were trying to build in the same market they have the experience. But, let's say someone has exited 2 projects in Los Angeles or somewhere in OC, I'm not sure, in Southern California. And they're looking to buy, a new construction op in Vegas, right? Or something to that effect. We will very much lend to that sponsor. We're probably going to look a little more closely at the comps and the scope of the work. So, if they had two deals worth of experience in Southern California, and those were $1 million projects respectively, and this new build in Las Vegas is 3 million, that's probably not one that we're comfortable with, because it's both a new market and it's an entirely different scope of build, right? Type of asset. So that's some of the items we're going to consider there is if they've got very similar build experience, just in a different market or sub-market, that's not inherently going to preclude us from lending. Those are deals that we'll look at. Those are sponsors that we'll look at, rather, the better way to put it.
Hey, Dominic, did you have any questions in regards to the build? I remember you sharing with me a client here in the South Bay that has experience and quite a bit of appetite of continuing to grow and build down the coastline. Do you have any other questions you wanted to ask?
Not on that one. Well, I mean, like if someone can prove that they can, well, I guess if someone can prove that, let's say they're purchasing a property that they can split the parcel to then build that second unit and it has its own tax lot, is that something you guys are fine with?
Yeah, that's something we'll look at for sure. If they're knowledgeable on the permitting involved and required to get that done, and they've got their ducks in a row, and their scope of work accurately reflects, site prep, permitting, to parcel out and ultimately begin the build. Yes, those are opportunities we'll look at for sure. Now, in a vacuum, what we really love to see for a build loan is vertical, right? We don't love horizontal builds. So, for example, the type of opportunities that we shoot down pretty often are, hey, I've got a client and they're doing a 30 door, 30 SFR development outside of Dallas, right? Those are not projects that we want to jump in on, right? There's much more money on the line. Starting 30 projects simultaneously in one development is a lot. We prefer to take down, one or two, at a time until the borrower exits from those projects, right? Now, if they've got experience and they've done 10 builds in the last 2 years, that's a different story, right? They know what they're doing. They're a big time developer. They've proven their experience. Then we can look at taking down more like 5 projects at a time, right? But we're not a huge fan of the horizontal development. Ideally, for a build loan, we have shovel-ready lots looking to go vertical.
Any other questions?
Yeah, I have another question. Sometimes I do come across a lot where there is mixed use, and like, let's say for instance, there's a barber shop in the front and the back is residential. They live there. I've come across where some instances where the city doesn't want to provide like a rebuild letter, so there's no way that we can do that particular deal. And I guess it'd be more commercial, I guess. Do you guys have an appetite for that type of financing or for that project per se?
Would this be a rehab project or a permanent debt DSCR project? Or what?
No, it's permanent.
Yeah, for sure. As long as it is legal, as long as it's legally zoned, if it's non-conforming or it cannot be rebuilt, that's okay. We're just going to make sure that the insurance captures that, right? If the insurance provider can't provide a replacement cost estimator, or the city's saying it can't be rebuilt, we would just have to upsize the insurance to make sure that the insurance amount covers, I believe it's at least 80% of the loan balance, right? But yes, that would not preclude us from lending. Those are opportunities that we'll look at.
Oh, that's awesome. Yeah, because the city, if they don't want to provide the rebuild letter, then that's an issue for us.
Right.
Awesome. Thank you.
Welcome. Very cool. Well, thanks again for the time, guys. And sorry if I droned on for a little long there. I love what we do. I love what I do, and I think we've built a pretty well-rounded product offering. So Kevin will be running legs on anything you guys might see, but we are all ears. Happy to take a look at some deals and really hone in on the box, right? So we can put a pin in what the appetite is and ultimately put some notches in the belt. So thanks for having us. I really appreciate the time.
Thank you, Colin.
Thank you, Colin. Thank you, Icor.
Thank you,
Thanks.
everybody.
Thanks, Colin. Thanks, Kevin.
Our pleasure.
Bye, everybody. Thank you guys so much.